Hello all, I am Apoorva. Welcome to one of my first video series on Introduction to Mutual Funds and its categorization in present Indian market. When I started investing in mutual funds initially, I did not have a clear picture of what exactly I'm doing. I took some advices of agents and brokers and have had my share of profits and losses in the current Indian market. Out of personal interest, I started reading and learning more about the mutual funds, stocks, various investment instruments, tax implications, etc. And frankly, have not come across one particular video or a series which is really helpful and is unpaid for. Hence, for the benefit of all those beginners and professionals who would want to venture into the world of investment opportunities in India, I am presenting this video. Please read the disclaimer at the end of each video carefully, and let's begin. So, what exactly are mutual funds? A mutual fund is an open-end, professionally managed investment fund that pools money from many investors to purchase securities. These investors may be retail or institutional in nature. Now, this is the definition of a mutual fund from Wikipedia. But in order to break it down into simple terms, mutual fund is basically an investment instrument. A group of people, in our case the fund houses, pool in money from different investors and invest the collected amount in a set of different asset classes such as equity, bond, gold, foreign securities, etc. People resort to this as it provides better returns when compared to the standard investment practices like your savings account, fixed deposits, or recurring deposits, the FDs and RDs basically. Of course, better returns comes in with its own associated set of risks. Now, let us take a look at some of the terminologies to be kept in mind, as these will be mostly used in this area of mutual funds and investments. The first one is AMC, which is nothing but the asset management company. These are the fund houses which I spoke about before. So these are the people who manage the money which is pooled in, or the ones who actually invest in the various asset classes. Coming to the next one, it's NAV, which is nothing but net asset value. This is the price you pay to buy or sell one unit of the fund as per the market value. So it is calculated as the assets minus the liabilities removed divided by number of outstanding units in the fund. Next one is the ROI, which is the return on investment, and this is calculated in various ways like annual returns, compounded returns, etc. But the calculations of which I will not be going into details in this particular video. Maybe I'll take it up in the upcoming videos. Next one is the growth or dividend option. These are the two options that you have while you are investing. So in case of growth option, your profits are reinvested. Suppose you make 100 rupees profit on a fund of a 1000 rupee fund, then this 100 rupees will be reinvested into the fund, and your profits for the next time will be calculated as 1100. So your NAV basically keeps growing because you're investing more money with the profits and the initial principal. So this actually helps in compounding of the money that you're investing and hence will yield better return. Whereas in case of a dividend option, the profits, if available, are paid out regularly. So the NAV remains constant and comparatively lower returns compared to the growth option. The next one is direct or regular plan. This investment is also something which you should have already considered before even starting out on your investment. So in case of direct plans, you should have a know-how of how the market works, how the mutual funds actually, where all they have invested in, which are the asset classes. So you'll have to do a lot of self-research before actually investing in a particular fund. This will yield higher returns And you will also have to have a constant review, say for example a quarterly review, or you want to do a daily review, or you want to do a monthly review or a yearly review. So it depends on your own individual needs. So there is no advice here, because basically you're investing directly through an AMC. So there is no broker or an agent or a middleman who will actually provide you certain advice that you have to invest in a particular fund and you should not invest in a particular fund. So there is no such advice which is actually given out to you. Whereas in case of a regular plan, there is an agent or a broker who will do the research and he will advise you. So based on his advice, you will have to invest in a certain set of funds. So comparatively lower returns, because the investment advisor or the broker will charge you certain amount from the NAV for his advice that he has given you. And there is a constant review which is done by these particular agents or the advisors. So they will charge you for this as well sometime. Now let us move on to some of the pointers to be considered before actually investing. So here I have listed some pointers which you have to consider before you are actually taking on a fund to invest. So the first and foremost is the risk factor. Market risk is something which will affect the performance of your fund in a variety of ways. Natural calamities, political unrest, pandemics like the COVID-19, recession, inflation, and others. Liquidity risk comes into picture when there exists a lock-in period for the fund that you have invested in. This is applicable especially in ELS's category of funds and also in a few other funds. So funds are usually classified into various categories of risks depending on all of these above factors like low risk, medium risk, moderately aggressive, amongst others. Second is cost, which is nothing but the fees or the charges charged by the AMCs for managing the investor's money. They deduct some amount as fees or charge from the NAV of the fund. As an investor, you must be aware of the exact amount charged by the AMC, as this directly affects your returns ratio. Third one is investment horizon, that is the time for which you would want to stay invested in the fund. Short term, ultra short term, long term, medium term, etc. These days there are a few liquid funds which you can even invest for less than a day. Next one is the taxes applicable. If you gain certain amount of profits when you sell a fund before a year, you will be entitled to STCG, which is nothing but the short term capital gains tax. And if you are investing for more than a year, you will fall under LTCG, that is the long term capital gains tax. So make sure you're aware of your individual tax brackets before buying and selling your funds. And last but not the least, financial goals, which is kind of the base to all the above factors. So basically you will have to align your funds based on some goals. For example, if you have a goal of buying a land in the next 10 years and you're ready to invest aggressively from now on, then this statement defines the above factors. Goal is land purchase, risk ratio is aggressive, you would have paid certain amount as charges to the AMC, which is nothing but the cost, investment horizon is long term, LTCG, that is the long term capital gain tax, will be applicable when you sell your funds bought now from 10 years. So this is just a random example I could think of and need not have to align to your goal and specifications. Now let us move on to the main types of mutual funds in the Indian market. So here are the three main types of funds in Indian market. First one is equity, second is debt, third is hybrid, and fourth is others. Coming to the equity, so equity funds are those mutual funds which mainly invest in stocks, hence they're also called stock funds. Usually it is categorized based on the company size and they yield very good returns with higher risk ratios. Coming to debt funds, they are the mutual funds which invest in fixed income or fixed interest opportunities in government or other bonds, securities and deposits. comparatively lesser returns with little to no risk ratios. Hybrid fund, as the name suggests, provides diversification of funds investing in both stocks as well as bonds. It reduces the risk ratio of equity funds and provides optimal returns. Others include ETF, which is nothing but the exchange traded funds, fund of funds, index funds, retirement, children fund, etc. These funds more or less fall into one or the above categories, but not completely. I'm not covering this in detail as of now. The next few slides shows you some of the fund categories you can choose from out of these above 3 main funds. Please feel free to pause the video to go through the different type of funds, and I will be covering these in detail in the upcoming videos of this investment series. As I had mentioned at the beginning of the video, kindly go through the disclaimer above before taking the first step into investing. And with this, I conclude by welcoming you all to the world of investment in Indian market. Thank you and see you all in the next one. Bye.